Hi there, Bob Graham, President of Riggs Asset Management Company. Today I want to talk about some potential changes, keyword is potential, but potential changes we may be seeing in the markets, at least some things that have improved, I'll say, over the last several days to a couple of weeks. In order to do that, I want to kind of start off with the Federal Reserve and the meeting we had on Wednesday. So the Federal Reserve had their meeting that they have every 6 weeks. And while they left short-term interest rates unchanged, they made a key change in what they've been doing sort of behind the scenes. So since 2022, the Federal Reserve has been on this program, which is commonly referred to as quantitative tightening. That is, selling treasury bonds and allowing mortgage bonds to run off of their balance sheet. On Wednesday, they announced that they were cutting their balance sheet sales of treasury bonds from $25 billion per month, billion with a B, to $5 billion. They're almost at a point where we think probably in May or sometime this summer, they're going to say, we're not going to sell any more treasury bonds at all. So if you look kind of behind what's going on in the Federal Reserve, we think ending or at least greatly diminishing quantitative tightening. That's a benefit for the markets. And I think setting up for future interest rate cuts in the future also benefits the market. So let's talk about what we're seeing in the stock market. We've gone through about a 5 or 10% correction, depending on which index you look at. And it kind of looks like we may have put in a near-term bottom, or perhaps this is the bottom for the year. We'll find out. But what we are seeing, or have seen for the past week and a half, week or so, is that the number of stocks moving higher has greatly improved. More companies are moving above their 50-day moving averages and their 200-day moving average. We've seen the fear index, the VIX, spike at around 29%. And it's pulled back. Today it's at 19.6. Pretty much it's on its long-term average. If it gets below 19.5, 19, or into the 18 range, that's a very good sign for the markets. The other thing we've seen, a lot of buy signals, improvements in things like financials, improvement in certain technology, improvement in areas like healthcare. All of these are showing signs of improving relative strength. And the other thing I find really, really interesting is if I take the equally weighted S&P 500, which we look at all the time, which basically gives each company, each 5 of the 500 companies, one vote, versus the cap weighted, which is really driven by the Mag 7. What we're finding is that the average stock is doing better than the S&P cap weighted index. So anyway, we're into spring and we're actually seeing some green shoots and perhaps an improving stock market. We're hopeful, and if there's any changes, obviously we'll be watching it, but right now things are looking like they're improving. Anyway, if you have any questions about this video or anything whatsoever, please reach out to your Riggs Asset Management team member. We're here to help you and answer any questions and be here for you in any way we can. Hope you have a wonderful spring, and we'll talk to you soon. Thank you.